Oh, hey there. It's Mike. I'm just sort of counting how many of these little rocks we have. And so what I want to talk to you guys about today is accounting, little accounting. We're talking about PMI. And is PMI horrible? Is it good? What's the deal with PMI? Well, the truth oftentimes lies somewhere in the middle. So what is PMI? First of all, it's private mortgage insurance. So basically what it does is it gives, if you put less than 20% down on a mortgage, which most of the buyers do, especially the first-time home buyers, you're going to have to pay an extra fee. And so you're like, well, that's really stinks. Who wants to pay extra fees? Well, 20% down on a $400,000 house is $80,000. So if you don't have $80,000, you may never be able to buy. Could buy with, let's say 5% down. That's only $20,000, and now you have to pay PMI. So PMI is not great. Nobody wants to pay more, but instead of having to save up to $80,000 to get into the real estate game, you can get in with 20, or even less. You get in with 3% down, or even 0% down. But let's just use 5% down for this example. So you put 5% down. Now you have to pay a fee every month, which is going to pay for your insurance, private mortgage insurance. What does that do? Basically, when the bank has less than 20% equity, if you put less than 20% down on the value, there's a risk. If you lose your job or anything happens and say the market takes a turn, the bank wants to make sure if they have to resell the property that they're not going to lose money. So they only want to be in a position where they have lent out only 80% of the loan. Now, if they loan 95%, now the bank's at a little bit of a greater risk. So they make you, the borrower, the buyer, purchase insurance. Basically, if you lose your job or something happens and you can't pay your bills, and the bank has to resell your property, the bank wants to make sure they get all their money. And if they don't get all their money back, the private mortgage company will pay for the difference in what the bank is. So it protects the bank and allows the bank to give 3%, 3.5%, 5% down loans, 10% down loans, and allows you to buy. So that's where it's good. Costs you a little bit extra, per month. However, it does scale, so the closer you are to 20%, the less per month it'll cost you. It can cost you, $100, $150, $200, $250 a month added to your mortgage payment. But again, if you can get into the market and you can buy and you write up all this equity, it's worth it. Most buyers, especially first-time home buyers, put less than 20% down, so they pay PMI. There are some special programs that waive PMI or roll it in. There's some creative things, so give us a call. We can put you in touch with some of our preferred lenders, and they can give you all the education on that. But that's it, guys. PMI, yeah, it costs you some extra money, but it allows you to do things that you would not normally be able to do. So generally, it's a good thing, but you need to make sure you can afford it. If you can afford it, and it makes sense, not so bad. And once you own your property and you have equity of at least 20%, you can actually get rid of your PMI. So it's not like it has to be there forever. Some loans it sticks and you have to refinance out of it. Some loan programs you can just call them, get a new appraisal, and once you have 20% value in the property, they'll remove it. Okay, thanks guys. Have a great day. If you have any questions, give myself or our team a call. Bye-bye. I'm gonna go back to counting.